welcome everyone. I hope you're fine and doing great. I'm here to discuss another topic in corporate financial reporting, that is GAAP and IFRS, the framework for the financial reporting or financial accounting. In this topic, I'm going to discuss some basic contents with you, starting with the core principles of GAAP and IFRS, the principles which are common among both of them. Then we will be discussing about the key characteristics of financial information, moving on towards the assumptions of financial information. Then we will look into the modifying conventions of financial reporting, and finally we will discuss the final point, that is the future of financial reporting. Starting with the core principles of GAAP and IFRS, so there are some basic principles which are opted by both of these accounting principle, or you can say both of the boards, which are FASB and IASB. They have agreed on these principles of financial reporting, starting with the asset valuation principle. So, as we all know, that assets includes both categories, which are current and the non-current assets. And specifically, when we talk about non-current assets like property, plant, and equipment, investments, and intangible assets, how do we value them? Do we record them based on their cost, or we record them based on their fair value? Which one we opt? Asset value principle says that there should be some basis for choosing the principle which you are using to assign the value to the assets. Basically, there are two measurement principles which companies usually opt. One is the historical cost principle, and the other one is known as fair value principle. So, if you talk about historical cost principle, as its name says, that history, or you can say the cost which you have paid to acquire the asset. But sometimes we are getting these assets because of some non cash transactions, like giving another asset and getting a property, plant, and equipment in exchange, or you can say some other sort of compensation we are giving to get these property, plant, and equipment. So basically, the historical cost principle says that we should value the asset based on the cash or the cash equivalent price which we have paid or we have given up in order to get or acquire this asset, like property, plant, and equipment. Whereas the fair value principle says that whatever is the fair value of the asset, we should record the asset based on that value. So the price that would be received of for an asset in arm's length transaction means the current market price, the genuine price for the asset. So we record assets based on fair value. So for some categories of asset, we follow historical cost principle, and for some categories of assets, fair value principle is opted. Now, two common examples for both of them. Number one, if an asset's value is going to be permanently impaired means decrease in the value, and constant decrease in the value. You cannot expect, increase in the value. Then in that case, you have to write down the asset based on its fair value. GAAP and IFRS both agrees with this. So if you remember, in initial accounting courses, we used to calculate the impairment, loss on impairment for property, plant, and equipment. So that is because of continuous decrease in the value of these assets. Another important thing is the nature of the asset also influence which method you are going to use. So for example, monetary assets means investments in stocks and the bonds of other companies. We usually value them at their fair value, because we keep them for getting the price advantage. Like if we buy an asset or a stock for $10, so when the price will go up to $12 or $14, we will be selling it. So because of this, we should keep these assets at their fair value. So this method is dominant measurement for these types of assets under both IFRS and GAAP. So do remember, whenever we talk about historical cost principle, if we are recording the assets on their historical cost like property, plant, and equipment, we should always take care about the impairment. Impairments mean constant decrease in the price of the asset. Whereas for the fair value, we usually follow the monetary assets. They are recorded at their value, fair value, because we are holding them to sell them to take the price advantage. The second important principle under GAAP and IFRS is revenue recognition principle. So the companies, they are allowed or they are permitted to record their revenue only when they meet the following three criterias. So what are the three criterias which companies should meet in order to record the revenue? One is measurable, the second one is earned, and the third one is realizable. Starting with the measurable. Measurable means that we can calculate the amount of the revenue which we are earning. So for example, if we talk about the normal sales, it's not a problem because there is a selling price of our product, so measurability is not an issue for our normal sales. But for the long term contracts, the decision is important about the measurability of the revenue. What does long term contracts means? Your company is a construction company and you have signed a contract to construct a bridge within a period of 2 years. So the client has agreed to pay you, let's suppose, to $20 million for this purpose, for example. So how much revenue we should recognize out of this 20 million? Should we wait for 2 years or should we record it on annual basis? What should be our decision? So for such type of contract sales, you should decide that how much you are going to record as your revenue out of this total price. So for contract sales, companies must decide how much of the customer total payment will be allocated each product or service converted by the covered by the contract. So whatever you are supposed to do in this contract, like let's suppose you need to construct a bridge, so are you going to wait for 2 years or are you going to record your revenue on annual basis? So the special topic which we cover under the contract sales, that is known as revenue from long term contracts, and usually it is covered under intermediate accounting domain. But for the knowledge over here, I'm going to explain you a bit. There are two methods to recognize the revenue for the long term contracts. One is known as percentage of completion method, and the second one is known as completed contract method. Now for those products or for those long-term contracts, where the picture or the shape of the product which you are delivering to the customer is not clear or the value is not clear until the project is complete, we do not record any revenue until the contract comes to an end. So for such type of contracts, whole revenue is recorded once you complete the contract. That is known as completed contract method. Whereas there is another method which is known as percentage of completion method. In this method, by the end of the each year, like let's suppose this example was for 2 years, that you have to complete this construction of bridge in 2 years. So by the end of the first year, we will be checking how much work is completed, and the work completion is decided based on your cost. So let's suppose your cost to complete this contract was for example $10 million, and you already incurred $5 million cost in purchasing the stuff and all those things. So you are eligible to recognize the revenue of how much cost you have completed. So out of 10 million, if 5 million cost you already incurred, that is 50%. So it means out of total revenue, which is 20 million, you are eligible to recognize 50% of your revenue, which will be 10 million. So at the end of the first year, you will be recognizing $10 million. This is known as percentage of completion method. So in case of long-term contracts, we should decide which method we are going to follow and how we are going to recognize the revenue. So measurability is a major concern. The second thing is known as earned. Earned means you are eligible to record the revenue because your job is done. You are done with your requirements. Who are you? You are seller. So earn means implies that whatever the seller was supposed to generate, supposed to do to generate the revenue, he has already done it. So for example, your job was to deliver the furniture to your client, and you're done. The furniture is already delivered to the client, so now you can recognize the revenue. So if your job is done, you are eligible to recognize the revenue because you earned it. So for example, here's an example for you. Customer pays for the software package. There you have a software, you can say a company who makes the softwares and who give the services, post sale services to the clients. So there is a customer who pays you for the software package as well as for future upgradations as well. So the your company, you can recognize the revenue only for the product already delivered. So if you have delivered the software package to your client, you can recognize the revenue, but the payment which he has made for the future upgradation, you cannot recognize this revenue. This will be earned if you receive the payment. So the product which you already delivered, that you are going to record as revenue. Future upgrades cannot be recognized as revenue until upgrades have been produced and delivered, even if you receive the payment in advance. So if the client pay you for full package as well as upgradations, all the money, so let's suppose he paid you, for example, $100,000, for example. Out of this $100,000, $60,000 are for the software package, and remaining 40,000 is for future upgradation. So once you deliver the software package to the client, you are going to record the revenue of this 60,000. So you have received the cash of 100,000, you debit it, you credit your sales revenue of 60,000 only, and remaining 40,000, which is for future upgradation, that is your unearned revenue, which is a liability. You will record this 40,000 as a revenue once you will do the upgradation for your client. Third condition is realizable. It means that the seller can reasonably expect to get paid for the revenue earned. Your customer, uh, you know, uh, his financial position is that he can pay you the money. So in this case, you are going to check the health of your accounts receivable every time, because if the client is going to bankrupt, or he's already bankrupt, or he's facing financial losses, then in that case the payment of these accounts receivable are not sure. So that's why we always maintain allowances for accounts receivable. It is a contra asset account. So if there are doubts of customers financial health, then the revenue should not be recognized. If the revenue is recognized, like accounts receivable, we already recorded them. So what should we do? Then in that case, an adequate provision, or you can say allowance for the bad debt, should be included in the accounts. Okay. Moving on towards a principle which is relevant to the revenue recognition principle, that is known as matching principle. This principle says that match the expenditures with the revenue. So those expenditures, those costs which you have incurred to generate the revenue, they should be expensed in the same period in which the revenue was earned. So this principle implies that any cost that you have incurred to generate the revenue must be recognized in the same period as the revenue. So how you will be recognizing these costs? You will be recognizing them as expense. So revenue must be matched with the costs that were incurred to generate them. Moving on towards, so three basic principles I discussed with you. Number one, we did asset valuation, then we did revenue recognition, and then we did expense recognition principle, or you can say matching principle. Now let's talk about key characteristics of financial information. So the financial information should have the following key characteristics, starting with relevance. The information should be relevant. Relevant means that if you provide the information, it makes a change in the decision of the users. When they look at this information, their decision might change. So the information should be capable of making a difference in the decision. meaning it should have at least some predictive value to help the reader to forecast the company's future with more accuracy than if the information is not provided. So these information, financial information, they are, something which are important to make the decision for the future, for whom, for the investors. In addition, the information should be released quickly enough to help the investor and other interested parties. Companies are always advised to release their financial statements as soon as they complete their, annual, or you can say years. Like suppose as soon as fiscal year come to an end, the financial statement should be released. That's why most of the companies, they release their unaudited statements immediately once they prepare them, and once the audited statements are released, so these statements are replaced by auditing statements. So why it they release unaudited statements? They release them so that the reader can have an idea about the company's performance. Moving on towards reliability, the investor must be able to trust the financial statements, meaning why they are talking about it should be reliable, because fake information, or you can say the facts which are not correct, that information is not appreciated. So the information should be represented faithfully. Faithfully means whatever is economic reliability of the company, that should be reported. It should be neutral, it should not be biased. It means that while the financial statement measurements may be incorrect, sometimes, because of the typo errors or because of some missing information from the company sides, they could be incorrect or some errors in the financial statements, but they are not biased, they are by mistake, so corrections could be done for them. So that's why we say these errors are made in good faith, they are not deliberately biased, they are not done knowingly. Finally, they should be verifiable. Verifiable means when auditors test the financial statements of the companies, they feel that they provide the reasonable assurance about these statements or these facts and figures. So verifiability means that the information must be subject to audit by independent experts. It is audited once, and who are these independent experts? Usually, they are public accounting firms. Another key characteristics of financial information is consistency. Consistency means that the principles or the rules which are used to prepare the financial statements in first year or 1 year, they are followed, they are consistent in the second and the moving on years as well. They're consistent, they are not changed. For example, in the first year, if you're using for example, if a company is using average cost method to record the inventory, it should be the same in second year, third year, and so on. So it is not, appreciated that the company keep on changing its inventory recording method. This is one example. We have depreciation methods, we have many other methods as well which we use. But once you start using a principle or a method, keep following that, be consistent in the following year so that the reader does not get confused. But if due to any reason you are supposed to change this method, then in that case it is subject to auditor's opinion, means the auditor should agree with that. And also it's clear, indication should be given in notes to financial statement. Clearly it should be written. So consistency means that it is important to facilitate the comparison of the company's performance over time and across the firms and industry competitors. It is not only in the same company for the years, also it should be, consistent with other industry participants are reporting, the way they are reporting the statements, better to follow the same trend what is in the industry. The company is required to employ the same measurement approaches from 1 year to the next year as well. If there are changes in accounting methods, the effects of changes must be discussed in detail in the notes. In addition, if the changes are significant means they are material, they are of huge amount, then in that case they should get a qualification from the auditors, or you can say auditor should approve it. Let's talk about key assumptions of the financial information. Starting with entity assumption. Entity assumption means that the transactions or activities of the business should be recorded separately than those of its owners, especially in case of partnerships and sole proprietorships and the small businesses, small companies, single owner companies. It's very important that the activities of the owner should be separate than the business activities. The second key assumption is going concern assumptions. It means that entity or the company, it will remain in the business for foreseeable future. We shouldn't, it should be properly planning for the future years. We shouldn't do the reporting in such a way that next year we might be there or we might not be there. No, this is not advisable. So don't convey such gestures to the readers. So but when we say foreseeable future, it means that for near future, it is we are expecting that the company will keep on doing the business. It's not that company will last forever, it will never close the business, but the survival of the company is not threatened, means immediately next year is going to collapse. No, this is not the case. So going concern assumption means that the company will keep on doing the business for the near future, and so because its financials are good and it's going to work properly in the coming future. Because if going concern assumption is not considered, then in that case investors will not be willing to invest in this company. Moving on towards modifying conventions means that those things which are taking or you can say which are going to be the part of financial reporting now. Starting with the materiality. Materiality is a modifying convention that says that accounting regulations, GAAP or IFRS requirements are going to be less, tightened. They will be lower if the information is not material. In material means it's not a big amount. It's not going to impact the statements, with big dollar values. So when we say big amount or we say materiality, it means significance. So this convention says that accountant are relaxed that they can record the financial information in any cost efficient way if the information is insignificant or if the information is not material. um, like let's suppose if we have uh, property, plant and equipment, and in equipment we have furniture and we have, you can say, machines, and we have some cars and all those things, and they are of small amounts and collectively they make some big amount. So in that case we can collect them together and we can report them in one figure, which is equipment, rather than segregating them. But if you will see the financials of big companies, they don't write equipment, they combine the facts and figures. And sometimes they write the equipment and then later on, in notes to financial statements, they clarify in equipment what things are there. So accountants are relaxed that they can, combine or put the lump sum figure together under one head if the independent amounts are not of significant value, they are not big amounts. Another modifying convention is conservatism. Conservatism means check, the negative side. Negative side means in business record less revenues than expected and record more expenses or cost than expected. So, conservatism refers to the companies exercising care not to overstate assets and revenues and do not understate liabilities and expenses. Intentionally, companies report the assets and revenues, understated, means as less value they can record, they will be recording it. Liabilities and expenses, they are always overstated using the conservative approach. So usually in accounting conservatism approach, net incomes are always reported less than expected. assets are reported on the balance sheet at lower of the cost, meaning the assets should be measured at the acquisition cost unless the fair value is lower. So we record as let's suppose property, plant and equipment, whatever is their acquisition or the historical cost, and we a fair value, if it will be greater, we will not change their value, we will keep on recording them at their historical cost. This is what we do. But as soon as fair value starts going down, we record loss on impairment, right? And because of this, accumulated depreciation gets more credit, so we reduce the value of the historical cost if the fair value is decreasing because of the conservatism principle. So conservatism reduces the likelihood that the assets are overstated. If the fair value is greater, we ignore it. But if the fair value is going to be lower, it reduces, then we are going to account for it and we record the impairment loss. Loss on impairment gets debit and accumulated depreciation gets credit. This goes to the balance sheet and it reduces the value of the asset in the balance sheet. What is the future of financial reporting? Usually companies are thinking about it. So within the ongoing convergence of IASB and FASB, they are trying to establish two new principles, and there is debate going on about that. Number one is known as cohesiveness principle. Cohesiveness principle means that the relationship between the items in the financial statements, it's clear, and that an entity's financial statements are competent enough to they are complementing each other, they are matching with each other as much as possible. Before moving on towards the further explanation, let's talk about cash flow statement. In cash flow statement, we have our activities in three categories. We have operating activities, we have investing activities, and we have financing activities. Now, according to this cohesiveness principle, the reporting in the balance sheets and income statement is also going to be distributed based on operating, investing, and financing. Also, for the income statement items, they are going to be allocated to operating, investing, and financing domains. So, what is the purpose? The aim is to enhance the usefulness and understanding and understandability of the financial statement, and also they are trying to make sure that the statements are complementing each other, means they are matching with each other as much as possible. So in the future, it is expected that the balance sheet and the income statement will be reorganized into the same format, which is closely resembling with the cash flow statement. So let's check out some examples. This is the Hutch Manufacturing Company, and this is the consolidated balance sheet. Can you see on the asset side, this is asset side, and we have operating and assets, and then with the operating assets we are putting the liabilities as well, operating liabilities. Then investing assets and liabilities. Then financing. In financing, we have financing assets and financing liabilities. So can you see, balance sheet is not in this format, but they have designed it in a format which is relevant to the cash flow statement. Moving on towards the cash flow statement, we know that this is operating, investing, and financing. Moving on towards the income statement, can you see operating? All the operating activities are here: investing, then financing, then taxes, and discontinued operation. So they are trying to resemble the three statements. Another future principle for the financial reporting is disaggregation principle, but this is, most of the people are against it because of the issue of understandability. So disaggregation principle means separating the resources by the activity in which they are used and by their economic characteristics, just to provide the more details, more information in the financial statements for the users. So when the more details will be there in the financial statements than before, there is a challenge. The challenge is that the understandability will decrease because too much information will confuse the reader. So it is a challenge to ensure that the level of disaggregation for each component, disaggregation means not together, explaining as much as you can. So this principle is still controversial. Why it is controversial? Because no people says that notes to financial statement already provides the detail. So what is the meaning of providing greater detail inside the financial statement? It will create the confusion. So this is it about the discussion of main principles, assumptions, and some financial reporting convergent, or you can say upcoming principles. I will be coming back again with the discussion of cash flow statement soon. See you then. Take care, everyone. If you have any comments or anything is confusing you, please write in the comment section. I'll be answering that soon. Take care, everyone. Bye.